But before this afternoon's events, the market's eyes, as we mentioned a moment ago, were trained largely on Federal Reserve Chair Janet Yellen. She spoke to the Economic Club of Washington and made it clear she thinks the economy is improving. But is it strong enough to raise interest rates 2 weeks from today for the first time in 9 years? Steve Leisman reports.
Thank you. Fed Chair Janet Yellen making generally positive economic comments in a major speech in Washington, pointing the way to a potential rate hike at the Fed's meeting later this month. Yellen signaled a rate hike more through expressing confidence in the economy than saying outright that rates would go up. She cautioned that the data between now and the next Fed meeting, which is December 15th, could change the outcome. The data includes, most importantly, Friday's big jobs report. But Yellen was clear. The Fed's goal has been met on jobs, and she's confident will be met on inflation.
I anticipate continued economic growth at a moderate pace that will be sufficient to generate additional increases in employment, further reductions in the remaining margins of labor market slack, and a rise in inflation to our 2% objective.
The Fed chair acknowledged the dangers of hiking rates too early, but she was much more specific and pointed about the dangers of hiking too late. She warned that the Fed risked abrupt rate hikes if they waited too long, and that could cause recession. New economic data added to the case for the Fed hikes. The Fed's Beige Book suggested a bit more wage pressure in the economy. The payroll company ADP reported growth of 217,000 in the private sector in November, more than Wall Street expected. It pointed the way to a robust Friday jobs report from the government of at least 200,000. And Atlanta Fed President Dennis Lockhart said in a speech, quote, "The case for liftoff is compelling." San Francisco Fed President John Williams chimed in. He prefers to hike rates sooner rather than later. The big issues for Yellen and the Fed are the recent downturn in manufacturing and the surge in the dollar. That could further reduce inflation. But we may already be in a world where incoming data, if it's weak or strong, is processed by the market in terms of when the second rate hike will come, not the first. For Nightly Business Report, I'm Steve Leisman.